Assalamu alaikum and welcome to the Oasis Focus and Finance Show. I'm your host, Shafiq Morton. As always, it's great to be with you. In today's show, we have a look at tax. We all know that July is called tax season by SARS, and it's time to start to do our tax returns. In the program, we are going to be having a look at tax returns. We're going to also have a look at some numbers, and we're also going to show how you could file for that very important tax deduction. Joining me in studio today are Michael Swingler and Mansoor Mir. Gentlemen, assalamu alaikum and welcome to the show.
Good day.
Mansoor, explain to us, what does it mean when SARS makes this announcement every single July? It says it's tax season. Sounds like a hunting season.
Shafiq, before we move on to actual tax season and the opening of tax season and what it means, I'd like to take the viewers back to a concept of personal income tax and the importance of personal income tax. Personal income tax constitutes 36% of government income. That's twice the tax that is earned from companies tax. So it reinforces the importance of personal income tax and one paying your income tax so as to make sure that the country has sufficient funds to run effectively. Personal income tax is the tax that is paid by individuals on their personal income. Most cases it's from their salary. As and when you earn your salary on a monthly basis, your employer keeps a portion back and pays it across to SARS as part of your income tax liability. This concept is referred to as pay as you earn, Shafiq, or PAYE. Similarly, when you get your IRP5 certificate at the end of every year from your employer, it reflects the income that was earned from your employer over the 12 months, as well as the tax that was paid over to you, SARS, over that 12-month period, Shafiq. So when SARS announces that tax season is open, it's merely a reminder to individuals to prepare the annual tax submissions or reports that they need to submit to SARS. The annual submission is referred to as the ITR 12 from SARS, and this document includes all income that was earned by the individual, all taxes that were paid over the 12 months by the individual, as well as any deductions that he may have claimed against the income or taxes that have been paid over that period, Shafiq. The current submission for this tax year would be from the 1st of March 2015 to the 29th of February 2016, Shafiq. Every individual that earns an income over and above 350,000 Rand has to submit tax returns. So whether you're a salaried employer and you are paying pay as you earn over the 12 months to SARS, you still have to submit your tax returns at the end of the tax year.
You mentioned the dates of the financial year. In the tax season, as it were, are there any other important dates we have to remember?
Look, most taxpayers are non-provisional taxpayers. So again, salaried employees that pay as you earn. And I think the main date for them to remember would be the 25th of November 2016, because that is the final day in which you can submit your tax returns. That can be done via visiting the SARS branch or via e-filing. For your non-provisional taxpayers, they have to submit the returns by no later than the 31st of January 2017. I think SARS has evolved over the years and have made it extremely easy for an individual to submit your returns via the e-filing tax portals that were created. There's no need to go stand in those long queues any longer, going to the branches and spending in fact actually having to take a day's leave to go and submit your return. So SARS has made it relatively easy. Again, the important dates that you mentioned would be before the 25th of November for pay as you earn earners and the 31st of January 2017 for provisional taxpayers, Shafiq.
Right, Michael, the million-dollar question, literally, why do we pay taxes?
Shafiq, that taxation is the way that government collects revenue. And the important reason why government needs that revenue is to ensure that social and infrastructure spending can be implemented and be funded. In the areas, if we look at the obvious areas on the social side, our old age pension to the elderly, in South Africa. Other areas would be education, healthcare, the transport infrastructure. So without those services and infrastructure, the country and the economy will not be able to operate. I think that's the bottom line. We need those services and infrastructure to allow the economy to operate. And let's have a quick look at what happened. We've got a recent example in the last 10 years where a dysfunctional tax system in Greece and that a culture of not paying taxes brought the country to a standstill. And the country was effectively bankrupt. And they could not continue paying their old age pensions, could not continue paying salaries for government employees. So the effect of government not being able to collect taxes and the impact of not having a healthy tax culture within a country can have very negative impact on countries. And in South Africa, we've got more than 50 million South Africans that require services. So without the revenue to sustain social and infrastructure spending, we will not have a bright future in South Africa, because a lot of this infrastructure is built for the future. So paying tax is an important part of life, and it's an aspect that we all need to manage effectively.
All right, Mansoor, in the light of what Michael has just said, as a citizen of this country, what is expected from us in terms of this whole tax landscape?
Shafiq, I think firstly it's important that every person who receives an income is registered for income tax. This means that as soon as you start employment, be it formal employment where you're receiving an income from an employee, you are paying pay as you earn, or be it you receiving a salary from a business that you started, one needs to register for tax. And once you've registered with SARS for tax, you will receive a tax number, and it's incumbent on you to actually submit your tax returns annually, whether you are a salaried employee or provisional taxpayer.
Michael, I'm a registered taxpayer. We can use me as an example. Where do I go from here?
As Mansoor indicated, SARS has made it relatively convenient, and especially the online system. The e-filing is a very convenient system. But whether you're doing it yourself on e-filing, or whether you have a tax consultant or advisor that assists you, what really happens when you're completing that assessment is you're reconciling. So you're submitting your documents and your tax return, and then reconciling that tax that you have actually already paid during the year. Again, as Mansoor has indicated, a portion of my salary is deducted every month, and that's paid over to SARS. And when you're completing your tax return, you're effectively reconciling what's already been paid to the total amount that SARS would require you to pay. Now, in interesting areas is that you could have incurred some additional expenses, like a retirement contribution, like medical expenses, which are not included in that calculation that your employer does every month. So you could actually be getting a tax refund if you do that reconciliation by submitting your return, and you indicate to SARS that you have made additional contributions to your retirement annuity, or you've incurred allowable medical expenses. You submit that, and then in that reconciliation you will see that you might have actually paid more tax during the year than what you are liable for.
So it either reduces your tax liability substantially, or, as Michael mentioned, you're actually getting money back from SARS.
In some cases, you could have additional income. Let's say, for example, you've got investment income.
Correct.
Local or foreign investment income. That must also come into this process. And there's a lot of terminology that they use, the IT this and the IT that, but it's all on the SARS website, all these documents. I think what's important for Oasis investors is that with regards to their unit trust investments, they will receive an IT3B certificate. And that will have all the details of the tax component of their investment, what income was earned, and if the investor did sell or utilize some of their investment, there could be a capital gains tax implication. But again, it's not necessary for the viewers to know all these terminology. That would be set out on your IT3B.
Right.
And it would be clear there and disclosed as to what must be included in your return. It is important to also, if you have a more complex tax return, to get tax advice. And then the other point I just wanted to make, that on capital gains, there's actually an annual allowance of 40,000 Rand. So the first 40,000 Rand of capital gain or profit
The exemption.
would be an exemption
Correct.
from tax. So all these documents on the SARS website. I think a last point from an admin perspective is if you've now incurred additional retirement annuity contributions or medical expenses, you don't have to submit all those documents to SARS. You put the numbers on your returns, either on the e-filing or if you're doing it in hard copy, then you are required to retain those documents in your file at home. You open your tax file, you put your supporting documents there, and you have to retain that for 5 years if there is a query from SARS.
How do I go about, how do I calculate, how do I get money back from SARS?
Shafiq, that will come through in that assessment process and completion of your return. So the key point here is to collect your documentation during the year. If you are making additional retirement annuity contributions, is to keep record of that. If you're incurring out-of-pocket medical expenses, for example, is to keep record of that. As I always say, you've got to have a filing system at home, and we all use different systems. It might just be putting the paperwork or in a drawer somewhere, or saving those emails in a separate place. And if you save it in one place, it's easy at the end of the year or the tax year to put that together. But the key point is that if you've incurred additional expenses, and here it's important to disclose all of that to your tax advisor and make sure that you've included all additional expenses. You then document that in your tax return. You keep the supporting documents. If there are any documents that must be submitted with your tax return, you can also submit that. But most of the time you keep those documents. You indicate that you've incurred additional expenses. Once your assessment comes back, those additional expenses would be taken into consideration, and you will actually have a credit with SARS, and they would pay that directly into your bank account.
Mansoor, the next point, how do we go about calculating our affairs in terms of tax?
Shafiq, one would have to use the tax tables that SARS actually puts out there on a yearly basis. It does change a bit. The bands of income that you earn determines the tax bracket that you fall in, or the tax rate that you would basically pay. So for example, your first 181,900 Rand is taxed at 18%. The next band would move up to 284,100 Rand, which is at 26%. And then obviously your final and largest band would be at 41%. That's for individuals earning an income of over 701,301 Rand, Shafiq. So maybe to illustrate it, let's use an example, and let's take Mr. Dadu. Mr. Dadu is 60 years old and he earned 700,000 Rand as an income during the period 1st of March 2015 to 29th of February 2016. So he clearly falls in the 39% tax bracket based on the tax table that SARS provides us with. So his tax liability would be 149,619 Rand plus 700,000, which is his income less the 550,101 band, taxed at 39%, which total tax liability of 208,079 Rand 61 cents. But remember, SARS also gives every individual a rebate. So any individual under the age of 65, he has a primary rebate of 13,257 Rand. If you're between, or if you're 65, between 65 and 75, you get a secondary rebate of 7,407 Rand. And if you're over 75 years of age, you have a tertiary rebate of 2,466 Rand. So if we take the rebate into account, Mr. Dadu's income or taxable income of 208,079 Rand will reduce by a further 13,257 Rand, which means his actual tax liability for the 2015-2016 tax year would be 194,862 Rand, Shafiq.
Okay, Mansoor, let's go a step further. How can we further reduce our tax via the example of Mr. Dadu?
Okay, so as Michael mentioned earlier, that there are certain deductions that an individual is allowed to claim based on contributions he might have made. The most common and most easiest way of reducing your taxes or getting some tax back would be contributing to a retirement annuity. Then you also get a certain percentage back from your medical aid contributions. Maybe to emphasize the importance of saving for one's retirement so that you retire financially independent and during your retirement years, I'm going to use the retirement annuity and emphasize that in the form of an example. So let's take Mr. Dadu. He earns 700,000 Rand as an annual taxable income. Now, current tax legislation, SARS allows you to claim 27.5% of your annual income as a tax deduction, but capped at a maximum of 350,000 Rand. In the case of Mr. Dadu, 700,000 at 27.5% amounts to 192,500 Rand. So that means he's allowed to claim that amount as a tax deduction, but he can only do that if he contributes that into a retirement annuity or retirement fund between the 1st of March and 28th of February 2017. By him contributing, let's assume he does take the maximum deduction allowed and he contributes the 192,500. Now the fact that Mr. Dadu earns 700,000, that puts him in the 39% tax bracket. So the 192,000 is put away into a retirement annuity. His tax saving from that deduction would be 39% of 192,500, which means he will make a tax saving of 75,075 Rand in that year, which automatically, if we use the same example I've used earlier, his original income, taxable income was 208,000 and odd Rand, which with the rebate it reduced to 194,862. With his tax saving he's going to be making from his retirement annuity contribution, which is a further 75,075 Rand, his new tax liability becomes 119,747 Rand. Now that's a huge amount, 208,000 to 119,000. It's a huge amount of money he's saving in the form of taxes. I actually want to emphasize the retirement annuity contribution a bit further, Shafiq, and maybe to explain the advantage and show the importance of actually maximizing your contribution to a retirement annuity on a yearly basis. So let's assume Mr. Dadu is 30 years old. His anticipated or date for retirement is at 60. So if his salary, and again we're assuming his salary stays 700,000 from now until retirement age, I'm sure he won't be too happy about that, but let's assume it does stay 700,000 Rand. 700,000 at 27.5%, the 192,500 is what he's allowed to put into a retirement fund, and he claims that deduction for the next 30 years. So 192,000 at 30 years means he would be putting pure capital, his own money, into a retirement fund of 5,775,000 over a 30-year period. The tax saving he's going to be making over that 30 years is 75,075 Rand, which is the 39% of the 192,500, multiplied by 30 years, is 2,252,000 rand. Now that's a huge amount of money you're saving in taxes, even though it's over a period of 30 years. Nobody's going to give 2,252,000 rand back to you for putting money away for your own retirement, to secure your retirement and to be financially independent during your retirement years. So for me, that's probably one of the biggest ways one can save for your taxes on an annual basis, by contributing the maximum to a retirement annuity. Another example I want to maybe use, Shafiq, and that's just to touch on where Michael explained capital gains tax, just so that the listeners out there or viewers understand how capital gains tax works. Capital gains tax is not separate from tax. It forms part of your tax returns, and the only way capital gain tax comes into play is if you've realized a gain from selling an asset, be it an investment property, not your primary residence, but an investment property, or even let's use a unit trust for argument's sake. So you put in 1 million rand in 2007, today it's sitting at 2 million rand. You've realized that investment. You've pulled out the entire 2 million rand in the 2015-2016 tax year. So it then becomes liable for capital gains tax. So your base cost when you invested the money in 2007 was 1 million rand. When you pulled it out was 2 million. So effectively, you've made a gain of 1 million rand. Capital gains tax, as Michael said, there's an exclusion of 40,000 rand per annum. So of your 1 million rand, you subtract your 40,000 exclusion. So we're sitting with 960,000 rand gain, which capital gains tax says 40% of your gain is taxable at your tax bracket. So in Mr. Dadu's case, he falls in the 39% tax bracket as we calculated. So 960,000 less million rand less 40,000 is 960. 960,000 at 40% gives us, and multiply that by 39% tax bracket, gives us a capital gains tax liability of 149,760 rand, which means that the effective tax rate on a 1 million rand gain for Mr. Dadu was 14.97%. Shafiq.
Right, Mansoor has crunched the numbers. I can't do arithmetic like he can. Michael, I've submitted my tax return form now. What happens next? Do I run for the hills?
Shafiq, in most of the cases, the tax return that you've submitted and the PAYE that you've paid during the year will be sufficient to meet the liability. And then you'll just get an assessment from SARS effectively saying, thank you very much for being a good South African citizen.
All square.
All square. If you've earned additional income, from in addition to your salary, let's say you've got a personal business, or you've earned investment income, then there will be an additional liability, and you will be given in your assessment the amount, and you will also be given a timeline or deadline within which to pay the additional taxes. If you want to object against an assessment, that is possible, but unfortunately you first need to pay the assessment, and then you can go through the objection process. What Mansoor has highlighted and what we focused on a lot today is that there are many ways of actually managing your taxes more efficiently, and in a lot of cases you can actually get a refund, as we've also covered, and that is where you've made additional contributions to your retirement annuity, or the other example that we gave was on the medical expenses. You disclose that, you include it in your return, then you will get your assessment, and it will indicate that SARS actually owes you an amount of money. And again, that will be paid into your bank account within a specified time period.
Right, our final question, Michael. If we submit late, SARS will send us a nasty letter. We have to pay some penalties. Just quickly talk about that.
Just before we go to that deadline, if there is a valid reason why you require an extension, So it has to be a valid reason. It can't be that I've been on holiday or something like that.
I always thought that was a valid reason.
But let's say there's a delay in you obtaining information. Let's say you've got a foreign investment and you still require information. If there's a valid reason, you can ask SARS. But it's important that you do that timeously and not at the last moment. So that's I think one important point. And SARS, they are reasonable in terms of providing that. But the key point here is that it's a serious offence not to disclose, not to pay, and tax evasion. And with that goes very serious penalties, including fines and potentially imprisonment. So it is a serious offence. From a practical perspective, it can also have an impact on your life if your tax affairs are not up to date. For example, if you want to make an offshore investment or if you want to draw on from your retirement benefits when you retire, you need a tax directive.
Absolutely.
And that can be very inconvenient if your tax affairs are not up to date, because you will not be able to draw
I've actually had a case where a client had the past 3 years tax returns that were outstanding, and he tried to opt for retirement, and he couldn't opt for retirement because we couldn't get the tax directive.
Yeah.
Because when you're opting for retirement, you need to have a no tax directive in order to retire, basically. So he had to actually submit his returns for the previous 3 years before we could opt for retirement from his retirement.
And unfortunately, that client would have incurred penalties as well.
Absolutely.
In the process. So, Shafiq, the bottom line is that it's always advisable to develop good habits and be disciplined in your tax affairs. And then I think Mansoor has clearly illustrated that it's also a good habit to speak to your investment advisor on an ongoing basis, because there are very tax efficient ways of saving that actually reduces your tax liability.
Absolutely.
And again, it's government's objective to encourage saving so that South Africans can retire and maintain their standard of living. And that's why there's these incentives. And that's why they reduce your tax payments if you save more for retirement. So good habits, be disciplined, but also speak to your financial advisor on a regular basis, because he or she can actually have a positive impact on your tax liability through the advice that you receive, and then ultimately you're receiving your investment objectives in a tax efficient manner.
Gentlemen, thank you very much. And that concludes this edition of the Focus on Finance show, during which we had a look at the tax season and tax matters. A special thanks to our guests Mansoor Mir and Michael Swingler. Should you wish to contact Oasis, you can call 0860 100 786 or email info@oasiscrescent.com. Until next time, I'm your host, Shafiq Morton. Assalamu alaikum wa rahmatullah.